Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Tim Bratz. Tim began his real estate career as a commercial real estate agent in New York City. After leasing a 400 square foot retail space and calculating what the landlord was making over the term of the lease, he quickly realized he was on the wrong side of the transaction. He knew he had to be an owner of real estate. Since then, he's done hundreds of residential flips, turnkey and development deals, and over 1,300 units in multifamily, and has another 700 units under contract. Based out of Cleveland, Ohio, Tim Bratz. Welcome to the show.
Hey, Juan, thanks for having me, buddy. Excited to be here.
Hey, thanks, and go Astros.
I don't know about that. Go Tribe.
Yeah, I know you're Indians fan, so had to throw that in there. And playoffs started, so we gotta, we have that fever right now, playoff fever. So it's October, and it's gonna be fun. It's gonna be fun. So we'll see what happens.
Yeah, I love it. We'll see.
Yeah.
We'll see.
So, Tim, you have a bunch of, experience and, a bunch of knowledge, and, I'm sure that my audience could get a lot of value from it. So, let's kind of go back to the beginning, and, I kind of covered your intro a little bit, how you got started, but, let's go back to the very beginning and, and go more in detail on that.
Yeah, man. I mean, I was going through college when the market was booming, 03 to 07. And so, when I was 20 years old, what motivated me was money, and I decided I wanted to get involved in real estate. So my brother was actually living out in New York City at the time. I'm from Cleveland, Ohio originally. And so I moved out to New York, and I got my real estate license, became a commercial real estate agent, essentially brokering leases for retail and office space. And so the first lease I ever brokered, the owner was leasing out a 400 square foot retail space in Greenwich Village of Manhattan. And he signed a lease for $10,000 a month for 400 square feet with a 4% escalation, which means the rent's increased by 4% every single year. And it was a 12-year lease agreement. And so I'm doing the math on this thing, and I'm like, this guy is going to make almost $2 million for something he did at one point in time, and he's going to get paid on it for the next 12 years. And so I was like, I'm on the wrong side of the coin. Instead of brokering real estate, I need to be owning real estate. And that's kind of what motivated me to read a little bit more on wealth and real estate. And so I ended up moving down to Charleston, South Carolina. I lived down there for like 5 years, and just kind of on a whim, wanted some better weather. And this is right after the market tanked 09. And I was trying to look to buy a house. I realized that if I was going to learn how to swim, I needed to jump in the water. And when I was there, I didn't have a lot of resources, but I was pretty resourceful. And I think if you're resourceful, you figure out ways to get around that stuff. And so I called up my credit card company. And again, man, I'm 23 years old at the time. I had zero credit. I don't have a mortgage. I don't have a car payment. I don't have anything. My credit card limit was like a couple $1,000s. And so I asked them to increase my credit card to $100,000 so I could go buy a house. Yeah. And they're like, absolutely not. But they give me $15,000. Yeah. So I made an offer on the cheapest house in the entire MLS. And it was at 25 grand. I got it for 14. And then I just did all the work on it. I cleaned it all out. I fumigated this thing. It was covered with bugs, and painted the inside, painted the outside, changed out the carpet, did the landscaping. And then I didn't know how to sell, so I just printed out a bunch of flyers and handed them out to everybody and held an open house. And one of the neighbors came through, made me an offer for $33,000. I made 14 grand in 75 days as a punk 23-year-old kid. And I don't even know what I'm doing in the worst housing market, in 80 years. So, I did it again, just kind of learning the ropes. And then I got into wholesaling. So I'd contract a property, sell the contract, and make money that way. And then I just started meeting people who had money, but they didn't have the expertise or they didn't have the time to go and invest in real estate. We kind of joint ventured and collaborated on deals. And man, I gave up a lot of equity in my first several hundred deals, probably 50 to 70% of those deals all went to the money versus me doing 100% of the work, which was a lot of heavy lifting. But I realized I need to kind of build up a resume and get some deals under my belt, and I can go and posture up with private money more, and posture up with banks, and then posture up with sellers. And so you can't do that unless you have a certain amount of experience under your belt. So was able to do that. And then, some of those relationships kind of fell apart. I've just been doing my own thing for the past about 3 years now. And we were doing a lot of single family flips, mostly turnkey residential houses. So we'd buy a house, fix it all up, put a tenant in place, package it with management, and then sell it as a turnkey package to an investor. And we did several hundred of those over the past couple of years. And about 12 months ago, I was like, where am I spending my time versus where am I building my wealth? And I was spending about 10% of my time on my apartment buildings, and it was 90% of my wealth. And so I decided, what would it look like if I dedicated all my resources and just pivoted from buying single family houses and building other people's wealth to buying apartment buildings and building our own. And so that's what we ended up doing. I just took my team. I don't have a big team. There's 5 of us. And so for me, I raised all the money. So instead of raising money for houses, I started raising money for apartments. My COO started just, instead of operating houses, he started operating an apartment investment company. My acquisitions guy, instead of looking at houses to buy, he started looking at apartments to buy. My project manager, instead of renovating houses, he started renovating apartments. And my disposition guy, instead of selling houses, he started managing a portfolio of assets. And that's all we did. It was a pretty simple and easy pivot for us. And it's amazing when you make that kind of commitment, to the universe, whatever you want to call it, but like how that comes back to you. If you burn the ships, the opportunities that present themselves are pretty profound. And yeah, man, I picked up 1,000 apartment units in the past 12 months. So we have another 700 under contract right now.
I mean, that's insane how you started, and basically in residential, I know you said that, you were a commercial agent in New York City, but, I think, you started building your business, in the residential space. Mm-hmm. And, you quickly, it took you, a little while to realize that you're spending so much time on it, and you wanted to spend more time on, building your wealth, and which is the apartments, and, that's really the best way to do it. And so what made you realize that you can take apartment investing to a big level? What made you, I think you said you started, in the past, I think I heard you say that you started with like an 8 unit. So what made you realize that you can take this and create like a big business out of it?
Yeah. I think a lot of people get involved in real estate because of the allure of passive income and residual income, right? And then all of a sudden we all get stuck in this transactional phase of flipping houses or wholesaling or whatever. I fell into apartments 5 years ago, about my first one, and it was an 8 unit. Like you said, it was very cheap. And I was like, I can't lose on this thing. So let me just buy it and figure it out. And I was like all in for, I don't know, like $10,000-$15,000 per unit. It was like a C-class area. But it was like a 30% cap rate that I was getting on this thing. And so, like the numbers, I just couldn't lose. And then I reflected on my business that year, and I was flipping houses, and I was doing low-end rentals, and I was doing apartment buildings, and I was doing retail flips, like high-end stuff and low-end retail flips. And just looked at my business and realized that like there's a lot more scalability, I guess, in apartments. And I was still like flipping apartments. Like I would buy it, fix it all up, stabilize it, and then essentially offer like a turnkey apartment building. And realized that it was less stressful, because if the property didn't sell, I'm not sitting on all these like holding costs like you are with residential retail flips.
Yeah. Mm-hmm.
With apartment buildings, you still have tenants paying your rent. And so I'd make just as much money, if not more money. I actually made a lot more money when you calculate in the rental income, and it was less stressful for me because if it didn't sell, I didn't care, and I could hold out to get the price that I wanted because I didn't have those holding costs eating away at me. So then, I just kept on trading up. I did an 8 unit, and then I did another 8 unit, and then I bought a 14 unit, and then a 23 unit, and then a 30 unit, and then a 60, and then an 80. And like, all it is you're adding zeros, or you're just changing the number. It's the exact same thing. Mm-hmm. There's definitely some nuances in management, and then the financing is actually easier with apartment buildings than it is for residential. It's like I own a couple of vacation rentals down in Florida. It's easier for me to get a $3 million apartment loan than it is to get a $300,000 house loan for a residential vacation rental, which is kind of crazy. But, I think the reason for that is because the residential realm, there's a lot of unsophisticated people in the residential realm. Like there's a little old lady who just, husband passed away and she's 90 years old, and we need to make sure that she doesn't get taken advantage of by some shark, real estate investor who's only out to make a quick buck. Like, so there's a lot of things in place to protect that type of property owner. In commercial real estate, it's assumed that everybody's a very sophisticated investor. And so it's almost like the wild, wild west. Like it's just, it opens up the gates to financing options and, you know, how to operate. And like, there's not all the real estate regulations and, you know, commissions and all that stuff, like hounding people on the commercial side. It's assumed that you can take care, you're a big boy and you can take care of yourself. So, yeah, it's actually easier to do deals on bigger stuff, but you know, you also need to realize that it's sophisticated. It's war without the guns kind of a thing. You need to make
Yeah.
sure that you're not going to get taken advantage of. There's other people who are just like all about making the dollar and um, you know, they'll burn you in a transaction, and they'll look at you and say, hey, you know, it was a learning example for you. Like, this is going to make you better in the future. So now you learned your lesson, and you should be thanking me for burning you. Like, no, like that's not how I do business,
Yeah.
but there's people that do business that
Yeah.
way. And you got to just be very, very careful because they are more sophisticated investors. But yeah, man, I you know, I think uh, a lot of people get involved because they want the passive income, residual income, because they want commercial real estate, and then they're like, they get caught in the transactional bubble, and then they're like, you know, it's too complicated, it's too out of reach. I didn't go to school with a finance degree or a real estate degree, and I don't have like initials from some class I took behind my last name, and I don't come from a family that has generational wealth that's been doing this for 80 years. Like, neither do I. All I did is I took the residential stuff that I was doing and I parlayed it into commercial. I took those exact same principles and just rolled it into commercial. And what you'll find is, dude, commercial's an antiquated industry, commercial real estate. And so all the people that are in commercial are doing stuff old school. And so when you bring some new thought processes and new ideas to finding deals, to funding deals and financing deals, and then the operational side, dude, it's a game changer. I'm getting more deals than guys that have been in the industry. Like, they're coming to me asking me, how do I find deals? They're coming to me asking me, how do I structure with my private lenders? Because I just turn the whole thing up on its head, and everybody's like, what? And they think it's like revolutionary. It's not revolutionary. It's buy, rehab, rent, refinance is exactly
Yeah.
what my business model was in residential. I just took the exact same thing and did it with apartment buildings. Like, we're real estate investors. We don't pay retail price for anything. You know, like, I see all these guys right now buying apartment buildings at retail price, 5% cap rates. Like, who the hell is, like, you're going to lose your ass on that in a few years whenever it's time to sell or refinance. Like, you need to buy at wholesale prices, just like investors do in the residential realm, force the appreciation by making those value add improvements to the property. And then you create that sweat equity, you know? And I do the exact same thing with apartment buildings. I don't buy stable apartment buildings unless I know that I can get it for pennies on the dollar. Like, I still need to be all in essentially at 65 cents on the dollar of what the after repair value is. It's the exact same thing. It's just, we're talking about apartment buildings instead of single family houses.
Got it, man. No, those are some great points that you brought up there. So, um, I want to get into the markets that you are finding these properties. I mean, if you're, you know, all in at 65 cents on a dollar, I mean, are these markets that, you know, not typically, you know, the best markets, not a primary market? You're looking at secondary, tertiary markets, or what states, what markets are you looking at and finding these deals?
So I get that question a lot. And dude, there are motivated sellers in every single market. You ever read the book Acres of Diamonds by I think Cromwell? It's a very short book, and the premise of the book is there's this guy who lives in Mesopotamia somewhere in the Middle East back hundreds of years ago, and he's got this big farm, and he's just struggling. He's going paycheck to paycheck, and he wants more. And he meets some traveling wanderer merchant guy who comes through, and he goes, "Listen, um, they're finding diamonds, and there's mountains with diamond mines and all sorts of stuff in Europe right now. Like, why don't you go over to the Alps and go and get rich, because that's where everybody's making money right now." And so the guy ends up packing up his family, his wife, his kid, selling off his farm, and then backpacking and traveling all the way to the Swiss Alps. And he buys all these picks and axes and whatever, and all the supplies and material. And he's like, you know, digging for gold and diamonds and everything. And he's not finding anything. Now, he blows through all of his savings. I think his kid gets sick and dies. I think his wife hates him and leaves him. And he, you know, broke, destitute, and just discouraged, wanders back to his hometown and finds out that the farm that he sold is the largest diamond mine ever found in the history of the
wow.
world. And so
Yeah.
the premise of the story is that there's acres of diamonds in your own backyard.
Mm-hmm.
And I don't care if you're in Dallas. I don't care if you're in San Diego. I don't care if you're in New York City, Miami. Like, there's deals in every single market. So to say that there aren't deals or there are better deals in certain markets than other markets, it's not true. I think you can find deals in your own backyard.
Mm-hmm.
Are some markets a little bit, more difficult? Yeah, you gotta be willing to do the work that other people aren't willing to do in order to find those deals that other people can't find. But there are motivated sellers. There's somebody getting divorced right now who has to liquidate all their assets in New York City before they can finalize their divorce. They're a very motivated seller. There's somebody who inherited an apartment building in San Diego, California, that is a starving artist in, I don't know, in Europe somewhere. They don't care about apartment buildings at all. They want nothing to do with it. They just want it gone. They don't want the headache of managing it because, they're out, prancing around doing whatever they want to do that is not business oriented whatsoever, which isn't saying that one's better or one's worse. I'm just saying that, like, they're not interested in it. They inherited it. It's free money. So they'll take pennies on the dollar just to get it off their back. There's somebody else who, I just got a message today on social media, on Facebook Messenger, of a guy who's got 5 acres of waterfront land in Florida, just got appraised for like $2 million, and he's willing to let it go for a couple $100,000.
Wow.
That guy's willing to take, it's buildable for apartment buildings or whatever. So like that's in prime real estate where there's no other waterfront property, that much acreage waterfront property in that location, and he's willing to take pennies on the dollar because he just got ill and he needs to just liquidate it, wants it off his plate. He knows he's going down, a path of trying to just settle up his estate before he passes. And so there's people like that in every single market across the country. And it's not fair to say like there's more deals in one market than the other.
Right.
Naturally, I tend to invest in the Midwest because that's where I am. That's where my team is located. And I invest in the Southeast a lot because I used to live down there. I do like more landlord-friendly states versus tenant-friendly states. But I invest where I invest, not because there's more deals or less deals there. It's more because of just like the laws and the regulations and stuff. It's just easier to operate. And I already have teams and resources and partners and contractors and suppliers and stuff in those areas. So, I have properties in 5 different states: Ohio, South Carolina, Georgia, Texas, and Florida right now. And I'm open to looking at a lot of different other markets. It's just, I haven't, pull the trigger on any of those yet. So I know some of the best operators in the entire country in the residential realm. If they brought me a deal in their own backyard and they're willing to be boots on the ground there, absolutely, I would help raise the money for it. I'd sponsor the loan on it. I'd help coach and mentor them through that whole process, and I'd be a minority partner in something like that. So it's not to say that I'd like one market over the other. It just happens to be where my resources are.
Yeah, well, you explained it very well. So yeah, I appreciate that. So you talked about the markets. You talked about, how the market really has no impact. You just want to find a good deal, right? So, but how are you finding these deals? That's the next question. And how are you actually finding these deals and getting a hold of, fantastic deals?
How do you find deals on the residential realm? Like,
direct
how
mail,
do people find single family?
Yeah.
Direct mail, outbound phone calls. You're talking to probate leads. You're talking to divorce attorneys. You're talking to management companies. Think about where motivated sellers are who own rental real estate. Like, the most pissed off people I know who own rental real estate are the ones going to eviction court all the time because tenants aren't paying rent, because they got shitty management in place, or they have whatever's going on. They don't have the money to take care of the property, and so now the tenant's not paying rent. So they're either always in eviction court, or they're getting beat up in the housing department. So like, there's lists of violations on properties, commercial properties, at the housing department that you can go and pull from the housing department, and they'll gladly give it to you because they're pissed off at these slumlord landlords who aren't taking care of the properties. You go hang out at eviction court, you're going to meet all the attorneys and all the management companies for all the poorly run properties. There's going to be 2 types. There's going to be people who either just took over and now they're cleaning house. So like we're in eviction court a lot because we're just cleaning house, but at the same time, we're building relationships down at the eviction court with all the other attorneys and management companies saying, hey, we're looking to buy more properties. You know, if your guy wants to sell and he's just beat up by this apartment building, let us know. We'll make an offer to him as soon as possible. So like, you know, are you thinking outside the box? Are you being resourceful versus, you know, saying, hey, there's no deals out there? If you tell yourself there's no deals out there, you're not going to find any deals, you know? What you give is what you get, kind of a thing. And I'm a big believer in that. So, you know, we still drive for dollars. We still go and look for, instead of houses with tall grass, we look for apartment buildings with tall grass, you know.
Yeah.
We look for apartment buildings with boarded up windows instead of houses with boarded up windows. You know, we call for rent by owners instead of for sale by owners. And we say, hey, I'm not interested in renting your unit, but I am interested in buying your apartment building. Would you be interested in selling? And so this is the kind of stuff that commercial brokers don't do. This is the kind of stuff that traditional commercial investors don't do. And we're like, dude, I picked up 1,000 units. I'll have 1,700 units in less than 18 months, all because I'm willing to do the stuff that other people aren't willing to do. And all of it is B class areas. I don't buy anything in the hood. I don't buy anything even in marginal C class areas. I only buy in A and B class neighborhoods. And my cap rates are between 10 to 16% today in this market. So I'm able to be all into these properties, refinance back out, pull a bunch of money off the table, and then hang on to you know, these properties that cash flow like cows.
Yeah, that's insane. That's insane. But that's the way to do it, guys. I mean, yeah, it's just crazy. You know, I love it. So it's awesome. So how are you structuring your deals? You know, it's you know, how are you finding the money? How are you structuring your deals? You know, just kind of go into that a little bit.
Yeah. So you need to understand traditional syndication in order to understand why my model is better. Traditional syndication, typically you're buying a stabilized asset, which means there's not a lot of juice in the squeeze. Like you might be buying a $10 million building for $10 million. So your equity in that is really worth nothing. You know, like what you owe on is what it's worth. You'll make a little bit on cash flow, and you're essentially banking on appreciation and principal pay down on that. When you go do that, traditionally, you would give the investors 70 or 80% equity in the deal, and you as the operator would keep 20 or 30% equity in the deal. Make sense? So the investors only get paid, though, if the property's performing. If the property's not performing, if it's not cash flowing, those investors don't get any return on their investment. And typically, that's a 5 to 10 year play. So their money's parked for a long time. They might not see any money for 2-3 years, and then all of a sudden they're getting a 5, 6, 7% return. And then really the windfall of their money happens in year 7, year 10, whenever they sell the property. And that's when they get their internal rate of return, IRR, of 10% or 12% over the course of the entire thing. So here's why that's not good. There's a shitload of work that goes into stabilizing, renovating, operating, being boots on the ground in these apartment buildings. I'm sorry, and let me back up for a second. The way that the operator gets paid is they get fees for finding the deal. They get asset management fees, whether the property is performing or not. And the problem with traditional syndication is you're not congruent in your goals with the investors. The operators and the investors are not going down the road in the same direction in the same car. Like the operator's just nickel and diming and feeing the deal to death, and they're not looking for a good deal because they're in the fee business. The investors are not happy because they're not like, dude, if I invest in something, I want to see a return on my investment. I want to see money hitting my bank account, the interest payments immediately hitting my bank account. At the same time, I want some upside of the deal. But if I'm buying it for $10 million and it's worth $10 million, even if I have 80% equity in that deal, my 80% is not worth anything until year 10 when I finally figure that out. So that's traditional syndication. The way that I syndicate is I look for value add deals. You know, my way wouldn't work for I don't think, you know, finding retail and buying retail properties works for either way, but mine works specifically well for finding value add deals. And so what I do is I pay a fixed rate of return to my investors regardless of the property's performance. So when they invest with me, I go and get a bank loan at 5%, and I'll pay my investors a 10% fixed rate of return. So if you arbitrage, if you blend the rate of, if I'm paying 5% interest on 80% of the loan, and then I'm paying 10% interest on 20% of the loan, my blended interest rate that my cost of capital is about 6%. Does that make sense?
Yeah. Yeah.
So I can go and I have essentially 100% financing at 6% interest rate. It's an awesome deal.
Yeah.
And because I'm all into these deals, I'm into that $10 million building for $6.5 million because I'm finding off-market deals. I'm going direct to the seller. I'm not buying through brokers. I'm able to negotiate directly with them, get good loan terms. Like I'm not in a bidding war, so I'm not worried about competition or fear of missing out or anything like that, which allows me to then take my time, go through the due diligence period, and get a really good deal. So I'm all into my deal for $6.5 million, let's say. So while I'm doing that whole acquisition and value add process, I'm forcing the appreciation so much in a very short window of time. I can usually do it within 12 to 18 months. So that then allows me to go and refinance. So if the property appraises for $10 million, the bank will give me an 80% loan on that. So I get $8 million off the table, but I'm only into it for $6.5 million. So what do? That $6.5 million gets paid back to the construction loan and my investors. That's what that $6.5 million goes towards. And then I have a $1.5 million bridge or additional proceeds from refinancing the property. That now my investors out, they got 10% fixed interest for 18 months, let's say, 10% annualized. So if they invested $2 million, they got $200,000 for the first year plus another 6 months, they get another $100,000. So they made $300,000, let's say, and then they get all their money back. So now all their money's off the table. Then I give them 10% equity in the deal in perpetuity. So they get 10% of those refi proceeds. Now, 10% doesn't seem like a lot, but there's $3.5 million worth of equity. That 10% is worth $350,000. Whereas even if they had 80% in the other traditional transaction, they were buying at a retail price, that 80% is only worth, it's not worth anything because they're buying at 10 million, it's worth 10 million. Does that make sense?
I am. Yeah, it makes a lot of sense because so essentially what you're doing is you're getting a loan from both sides, from a bank and from your investors. And your investors, you're giving them 10% on their money, no matter what, right? So on the back end, once you refi the property, then you're also giving them an additional 10% of equity, right?
Correct. So now that 10% of equity yields, they get 10% of the refi proceeds. So they get another check for $150,000.
All right.
And then they get 10% of all the cash flow in perpetuity, which ends up being, on let's say something that is, let's say it's 200 units. That's worth about, that probably, yeah. So it's probably like 20 grand a month. So they get an extra $2,000 a month for the rest of their life, as long as we own this property from the cash flow of the property. And they're still, the property's worth 10 million, but our mortgage is only $8 million. So there's still $2 million of equity. So it builds their balance sheet. Now they can show their net worth increasing. They get all their money back and they have their net worth increased by another $200,000 because they have 10% equity in that deal. And that equity just grows, or that $200,000 worth of equity grows as the property appreciates and as the principal pays down. So they still get that same growth as if they were in a traditional syndication model, but they don't have any money in play. It's all bank money in play. And what my investors love is now I can take that money and I can roll it into another deal and another deal and another deal. And over the course of the next 10 years, maybe we do 5 or 7 deals together versus them doing 1, maybe 2 deals on the traditional syndication model. So now they can have their money making money, a better rate of return than what they would on the traditional syndication anyways. And they get 10% equity in all these little deals all around the country that are paying them little annuities of cash flow every single month, plus these big pops from refi proceeds and resale proceeds. So dude, like I think my model is better for both the operator and the investor. And the other thing is for me is I'm a very fair, I like to think I'm a very fair person. Right. So I don't take a fee on the front end. I don't take an asset management fee. I only get paid when the property refinances. So now I'm in bed with the investor and we're going down the road in the same car in the same direction to make sure we get this thing to refi. When it refis, they get their money back. I get a big chunk of refi proceeds, and now we're all cash flowing. And now that's like how a true business partnership should be structured. Make sense?
Man, yeah, I love it, dude. I really do. I think it aligns the interest of both you and the investors. And if you can refi out of a deal, whereas the investor has no more capital in the deal, but they still get cash flow and they still have equity in that deal. I mean, what do you think is going to happen with this guy? He's going to be like, well, I don't want my money back. Here, take it.
Where's
Go
the
make
next
me some
one?
more money.
Where's the next one?
Where's
Where's
the
the
next
next?
one?
Let's do another
Yeah,
one. Yeah. And by the
exactly.
way, I got some friends who have some money. Let's do like, so, I'm very fair with my investors and I lend my money the exact same way that I borrow money on these
Yeah.
deals. And so that's how I would want to be treated. And that's how I make sure that my investors are treated too.
And the other thing, like you mentioned, is the no acquisition fee and the no asset management fee,
Yep.
which that takes. I mean, depending on the size of the deal, I mean, it can take a pretty good chunk of the cash flow. If you're charging 1.5 to 2%, some might say it's not that big of a deal, but it's still something, And
Dude, I know some guys that take 4 to 5% acquisition fee.
yeah, I do too. Yeah,
Like,
yeah, I do too. When I heard it, I was like, wow.
More power to you. But the
Yeah,
reality, like, dude, you're not looking out for the best interest of your investors. And
right,
that's good for short term for you personally, but
right.
it's not good for the deal and for the relationship long term. Like, dude, I'm 33 years old.
Hmm.
I'm going to be in this game for a long time. So I need to make sure that I'm building my business the right way. A lot of these other guys are 55, 60, 65 years old. So maybe they don't give a shit. They're not looking for the
Yeah,
long-term play. But I am, I'm in this for a relationship. And I want to make sure that I have people that I'm doing the deals with today that I'm still doing deals with 30 years from now.
yeah, man. I really like that you were able to share it, and it's clear. It makes sense to me. For those of you guys that are listening that didn't get it the first time, then go back and just listen to it again, because he explains it pretty clearly. And if you want to get into multifamily, then either as a passive investor or as somebody that wants to take down your own deals, then this is another, and it's a powerful way to structure your deals, to where it's beneficial for both sides. So I like it. I'm a fan of it. That's not something that we normally, think of when we're thinking about syndications. You're thinking about more 70-30, 90-10, 80-20 kind of split, waterfall maybe at the end, whatever. But I like this because it's pretty simple. It's straightforward, makes sense. And
Juan, that's
it
the other
works.
thing. It's simple,
It's simple.
like it's so hard to explain traditional syndication to somebody who's
Explain a
not.
waterfall
Dude,
sometimes, to people. They're like, what the heck is that?
I don't know what it is. I still can't wrap my head around. I'm like, dude, I don't understand this shit. And if it can't be explained at a third grade level, I'm not doing it. So imagine how many other people who are not as sophisticated in real estate as me, like
Mhm.
what they think about when they look at like this offering memorandum and all this nonsense and like fluff. And like, dude, just make it simple for people to understand. I have 4 bullet points. Here's how you get paid. You get paid a fixed return. You get paid from refi proceeds. You get paid from cash flow. You get paid from long-term equity in the deal. Like, that's it. This is how it's done. This is when you're going to, how much you're going to invest. This is what it's going to look like. And here's when you're going to get your money back. And like, it's just simple. It's easy to swallow. It's an easy bite to take.
Yeah, and I think simplicity is the key. If you are able to show somebody that you want to bring onto a deal, and it's simple and they understand it from the get go, then people like simplicity. It's just that's just a
Big time.
matter of fact. If you can explain to them in a simple way, then they're gonna buy in.
Yep.
I want to ask you, what about the EPP Em, and like are you engaging like a syndication attorney? I mean, is it
Yep, it's still security. So you still need a
security? Yeah.
subscription agreement, a private placement memorandum.
Okay.
They're noted in the operating agreement. That's all part of the whole deal. We give them term sheets and all that stuff. So it's still all, regulated SEC. It's all compliant. Everything's good to go. We have, costs a few bucks in order to get all that paperwork
Right.
done.
Right.
But the reality is, like, you need that done. It's
Gotta get it done.
that
Yeah.
for you as the operator, and sets very clear expectations for the private investor. So you got to be a little bit creative, like,
Mm-hmm.
because like I've had to educate my attorney, my SEC, my securities attorney, on how to structure this whole thing and how to write it all out. And we were able to work through everything because you still need to stay in compliance with the banks, and a lot of times the banks don't want any payments going out to the investors without, unless it's from above a certain amount of cash flow that comes in from the property.
Right.
And so like we had to structure it in a certain way that was compliant with the banks and still gave the investors their security and still gave them their monthly payments. And it's worked out, cost a couple extra bucks. We had to think through it. We had to be resourceful. But we were able to make that happen. And now it's, now my attorney understands it. Now my investors understand it. Now the banks understand it. Like now it's all very easy. And now we just, it's very cookie cutter. We just copy and paste and do another one, do another one, do another one. So it's good. Now it's just finding deals, and there's deals out there, and we're turning over rocks. And, I'm turning down deals. I used to only look at stuff that I can get a stabilized cap of 10% or better. Now I'm bumping it up to 12% or better because I have so much deal flow coming through right now that, I need to be in good areas at 12 cap or better once stabilized. And so they're out there. They're all over the place. I get deals sent to me every single day. And now I'm just being picky on which ones I want to move forward on. But the goal is build up the balance sheet big time over the next 24 months. And then when the market shifts 2020, 2021, whenever that happens,
take advantage of it.
Be able to be the bankable person,
Mm-hmm.
I'm finding good deals, so I'm not worried. I'm not overpaying for anything. Market would have to shift significantly for me to get hurt. And I got non-recourse debt in place, long-term debt in place, fixed interest rate debt in place, long-term amortization schedules whenever I refinance all this stuff. So like the market can fall, tumble, and then by the time my loans come due, I'm in good shape, man. Like I don't have any investors to pay back. It's just, Freddie, Fannie money that's in play, non-recourse, and it's not due for another 10 years. So if you bought in 2006, even going through the Great Recession, by 2016, your property values are worth way more than what they were in 2006. So that's a way that you can kind of protect yourself going into like this economic and market that's like kind of unknown right now. There's a little bit of uncertainty going on in it. And yeah, man, that's what I'm focused on. So I just want to be the one who's bankable. I want to be the guy who like to make sure, like, yeah, no problem. He's got his operation dialed in. He's got a huge balance sheet. He's liquid. And look at all the cash flow coming in from all his properties. So that way, when nobody else can get financing in a few years, I'll still be able to sponsor those deals and acquire those projects that a lot of other people aren't going to be able to acquire. So I think I'm going to be able to buy, $1 billion worth of real estate in the next like 5 years for pennies on the dollar.
Love it, man. You have that. I always like to say is, there's a special kind of person that, that it takes to be able to, hustle and make things happen. And, you have that personality. And so I have no doubt that you're going to make it happen for sure.
Appreciate that.
Yeah. So, real quick, I guess, let's kind of shift on over to your vacation rentals, and I know that you have done some development, projects and vacation, homes as well. So kind of talk about that as well. And go over that.
Yeah. I think it goes back to like mindset. I think I fell into a mindset thing a year ago where you're like, oh, well, like maybe there's some other asset classes because apartment buildings are so overrun and people are overpaying for them. And so then all of a sudden you start looking at self-storage facilities, and all of a sudden you start looking at vacation rentals, and you start looking at retail and office and mobile home parks. And I think what people don't realize is like there's a learning curve every time you get into a new asset class. Like I've owned hundreds and hundreds and hundreds of residential properties, and I own 1,000+ apartment units. And buying a vacation rental was a huge learning curve. Like I had to bring in a partner to work on it on a full-time basis and give up a big part of the equity just because there's so much work that goes into it. Like when think about when you go on vacation, if you want to go stay at a house on VRBO and you message the owner, you expect a response right then, even if it's at 1:30 in the morning, when you're laying in bed and you're just looking at different houses. So like it's a 24/7 business, and it's a hospitality business is what it is. It's hotels, just on a smaller scale. And so people want everything to be top shelf, first class, super clean. Like people steal stuff all the time, like that's all part of the learning curve of going through that. So, I think I see a lot of entrepreneurs hop around from business to business or asset class to asset class, and they call themselves serial entrepreneurs. Like, I think people call themselves because they want to be cool and call themselves a serial entrepreneur. I get scared when I meet somebody who's a serial entrepreneur because that tells me they don't have focus. The people who have boring businesses that stick and do the same thing day in and day out, and they're an absolute ninja at that one thing, are the most profitable and most successful business owners that I know. So serial entrepreneur scares me because it tells me that you're all over the place. You're not making any money because you can't focus on anything, and you're just trying to start new businesses all the time. And when you don't give it the attention that it needs, it's never going to get off the ground. All that attention, like you take a look at an airplane uses up 80% of its fuel getting off the ground. Then once it's up in the air, it only uses the other 20% of the fuel. So it's the same thing with business. It needs a lot of attention to get it up off the ground. And then once you get to a certain point and you're coasting, that's the point. That's the time when you can go start looking at other asset classes. And I wouldn't look at a whole bunch of them. I would look at like one at a time. So yeah, I own a couple of vacation rentals. I bought 2 of them and I stopped buying them because they're a pain in the ass. Like they're a lot of work, and I don't have the, I make more money on apartment buildings. It's easier to finance apartment buildings. And, although apartment buildings, B-class apartment buildings are not as sexy as a vacation rental outside of Disney World or a beachfront house, apartment buildings have been around forever. Yeah. The financing is so easy on them. They cash flow like maniacs. They're a lot less management intensive once they're stabilized. The vacation rentals, they're cool. Like I'm still just testing the water with these 2 that I have. But until the financing gets easier, and the reality is, like, everybody thinks their beach house or whatever is worth way more than what it actually is. So I think that luxury realm is going to get hit pretty hard when the market does shift. And that's when I plan on like diving a little bit deeper into that too, and buying up, some resorts or whatever. But right now, man, I'm just focused on building the balance sheet. Every time I do anything other than apartment buildings, I end up going through a learning curve and either losing money, spending a ton of time on it, wasting resources. Like my team gets discouraged. I just bought a mountain last summer in on the border of New York and Pennsylvania.
What a mountain! The way you say it.
270 acres overlooking State Park.
Well, yeah, that is a mountain. That's like an entire mountain.
Dude, it was an entire mountain. I bought the whole mountain, and it was an ego play. I was like, they were asking $4 million. I got it for $850,000. I was like, I'm gonna make $1 million on this thing immediately. No, like I thought I could auction it off as is. Some builder would come in. The builder saw what I could buy it for because they're sophisticated buyers, and they were making offers for like $50,000 more than what I was into it for. So, like I couldn't do it that way. I couldn't auction it off. And then all of a sudden I told all my investors that they'd have their money back in 6-12 months. That didn't happen. Now we're going through winter. Nobody's buying vacant lots in the winter time. So now I had to extend the loan another 8 months. It's a shitty conversation that I have to have with my investors that I don't want to have and they don't want to have with me. Right. And it tarnishes my reputation then with those investors for this deal. And now we're just going to fire sale the lots off to individuals, and we might make, as a whole company with partners and everything, $100,000 to $200,000. And it's been nothing but a headache for a year and a half of my life. Same thing with buying a C-class apartment building. We're not good at managing C-class apartment buildings. We could buy it, renovate it, stabilize it, and then resell it. Like we do a little bit of that. But we're not good at managing them on a long-term basis because they're more management intensive. They need a lot of attention. And so I bought a 44 unit last fall. I was supposed to be out of it by next week. And I had to extend that loan for another 6 months. My investor's not super happy with that because now he's like, I was expecting to get my money back. We want to roll into some other deals with you and some of these B-class things and da-da-da. And it's just like every time I get outside of my realm of flipping or investing in apartment buildings and stabilizing value add properties that are B-class apartment buildings, I go through this learning curve and, I get like a hangover of doing different asset classes. And I'm like, why am I doing different asset? Like, this is what we're really good at. Let's double down on it. So this year's been a year of just like cleaning the slate and getting all those projects off my plate and not becoming a serial entrepreneur and being a boring ass independent entrepreneur in one asset class.
Yeah. No, that's the way to do it. That's exactly the way to do it. Just focus on what you're good at, focus on what has provided and proven results, and, success will follow, if you stick with it. Mm-hmm. So Tim, it's been a treat. So let's go ahead and get into our nuggets of wealth. These are questions that I ask every guest every week, and hopefully they are able to help them out. Cool. What is a good tool, source, or platform that you use almost daily that can also help others?
Man, I'm pretty simple. I run my entire business off of like Excel spreadsheets, dude.
Okay.
I literally use Excel for everything. And but our property management software is Appfolio, APPFOLIO. I've
Mhm.
used a couple different management softwares. I think Appfolio, if you're looking to build a portfolio of rental properties and manage it in house, you need a software. I think Appfolio is the best one. I think it's most user friendly, gives you the most um, data analytics, all that kind of stuff that whatever you would need, and it's very easy to manage if you're not data analytical and like I am. It's like I'm not at all. So I need nice colors and like buttons to push kind of stuff. So
Yeah,
that's it's easy
that's the
for
way
me
to do it.
to
Yeah.
navigate that software.
Sweet, sweet. Appfolio. Okay, check it out. What was the best business advice you ever received? I think you may have covered that a little bit, but I guess go ahead and tell us. What has been spoken to you?
I mean, the first thing that comes to mind on that is the whole resourcefulness is the ultimate resource. And I remember hearing Tony Robbins say that like a year ago, and I was like, man, that's like a really powerful statement. Like if you are resourceful, it doesn't matter if you don't have time, if you don't have money, if you don't have the knowledge, you can go and find those things. And if you can think critically and problem solve, you can get past any hurdle that life or business presents.
Sweet. Be resourceful. That's powerful. What book are you currently reading?
So I just finished up a book called "What Matters Most" by a real estate guy, Brian Scarone, who lives down in Florida. Really good book on just priorities and where you're spending your time. Like a lot of people say, "Hey, I'm building a business because of my family. I want to do it for my family." But the greatest indicator of your priorities is where you're spending your time, and that's not congruent of are they spending more time with their family than in their business. And so it kind of makes you reflect on what are your priorities and why are you building your business and what kind of business do you want to build, one that you run or one that runs you, kind of a thing. So I just finished up that book, What Matters Most, and I just picked up Tim Grover's Relentless. And so I'm going on vacation tomorrow. I'm going to break that one open tomorrow.
Sweet. I haven't read any one of these two, but I'll be interested in reading those. So, what matters most in Relentless? Um, so, what is the best strategy that you use to manage your time?
Time blocking for sure. So actually, I implemented that after reading. I mean, I didn't get that from What Matters Most, but um, one of the things that I do is I block off my time. Just like I'm on a podcast right now. I didn't double book um, this this time block because I know that I'm not going to pick up any phone calls. I'm not going to schedule another meeting because I'm on a podcast right now.
Mhm.
And I see a lot of people who they go home from work and then they're picking up their phone and they're answering emails, they're neglecting their family, and they're not paying attention to their kids. And what I noticed, like one time I was sitting right here in this nook at like after dinner, and I was answering some text messages, and my daughter, my 3-year-old daughter, comes up to me. This is like a year ago, and she's tugging on. She's 2.5 or something at the time, and she's tugging on my arm. She's like, "Daddy, come play with me in the playroom." And I was like, "Hang on, baby, let me finish up this text message." And I'm texting, and then she's tugging, and I'm like, "Hang on." And eventually, I finish the text message. I look up, and she's not there anymore, and she's going and playing by herself in the playroom. And I sat back. I'm like, dude, what the hell is wrong with me? My daughter just wanted to play with me during family time after dinner when I should be dedicating time to my family, and I'm answering text messages. And like even deeper than that, like what does that then convey to my 3-year-old daughter? That the man who loves her more than any other person in the entire world is ignoring her for a cell phone? Like what does that teach her to like what kind of guys is she going to date when she's older now? Like
Yeah.
is she going to go and date somebody who neglects her and ignores her, and like that's the kind of guys that she's going to be attracted to? Or like there's only so many times that you can do that to your kids, and that because every single time that your kid comes to you and you ignore them, now it's imprinting in them, consciously or subconsciously, that every time I go to daddy, I'm disappointed and disappointed. And how much does that compound where all of a sudden then they start looking for other ways to be satisfied, other ways of feeling appreciated.
Mhm.
And that could be through drugs, alcohol, bad influences in school, friend, like all that stuff. So when that happened, I made a commitment. I'm like, I'm time blocking family time. Not going to happen. That's just never going to happen again. And so I time block my evenings. I'm always home by 4:30, 5 o'clock, and the phone gets shut off. It goes upstairs. It's not even on the same level that I'm on. It goes upstairs, and I don't touch it. And everybody I know and everybody I do business with knows that I don't answer my phone between 5 o'clock to essentially like after kids and wife go to bed. Sometimes I'll go and knock out some emails or something at like 11, 12 o'clock at night and get some stuff done then, because then there's nobody else responding to emails. I don't have like, my inbox being flooded with responses and all that stuff. So, so I time block those evenings now for my family. Just like I wouldn't double book this podcast with another meeting and answer a phone while I'm talking to you. I'm not going to answer the phone while I have a date with my wife, or while I have a date with my daughter, or while I'm playing baseball in the backyard with my son. Like those are things that are more important than any phone call you could take. Like, what's the worst thing that could happen in business? So like my building burns down, I can't even file a claim until tomorrow morning anyways. It doesn't even matter, and it's almost like counterintuitive, but you're like, oh, well, like, what if I miss out on a deal? Or, and I understand that. And so I think there's this false sense of importance that we all have about ourselves and how needed we are in our business. I realized this by being at a mastermind for 2 days. And I didn't answer any emails for literally 2 days. And when I went through my emails, I had, 100 plus emails in my inbox. You know how many of them I had to actually respond to? Like 4 of them. Because everything else just automatically ended up handling themselves. Somebody else stepped in, or somebody was just lazy and they didn't want to look up the answer themselves. So they tried to send me an email so that I'd take my time to do it. Like, your inbox is not your to-do list. It's somebody else's to-do list for you to do, So when I just ignore it all, it ended up having taking care of itself. And so, some people might say, hey, I can't lose out on business, or like whatever, this or that. I'm at a certain place in my business where I have to answer the phone 24/7. Like, you'll find that people will respect you more in business, and they'll want to do more business with you because they understand where your priorities lie. That you're not just in it for a buck, you're in it for relationships. And so there's people who told me that they do business with me and they respect me and want to maintain our relationship and keep on doing business together because I focus on that aspect and I prioritize in that way.
Man, that's powerful, man. I love that you were able to share that. And, that's, it's something that it's easily can be ignored. Like you said, you can easily ignore your kids.
Mm-hmm.
And I mean, you got to think about why you're doing things in the first place, and that's, your family, is usually one of the main reasons why. So, last question, Tim. So at the end of your life, how do you want to be remembered?
That's a good question. I think one of the things that drives me is creating an example of what an exceptional life can look like, and being an influencer, or like having people be like, dude, this guy can do it, I can do it. Like, I know it's possible because somebody else was able to, have family and have friends and travel and have a successful business and have good health and all this other stuff. And so like, what drives me is to like set that example of what an exceptional life can look like, to inspire other people to, be their best in every aspect and of their life.
There you go. Where can Commit to Wealth Nation go to contact you and find out more about you and what you're doing?
I appreciate that, man. Yeah, I mean, I'm on social media. That's how we met, through Facebook. Uh-huh. And so follow me on Facebook or hit me up on Facebook if you guys have any questions on anything like that. If you got deal flow, whatever, you can either hit me up on Facebook or go to my website. My investment website is cleturnkey.com. It's like clevelandturnkey.com. And you can hit me up on that. And then, I do some coaching and some mentoring and some courses and stuff. And I do live events about once a quarter, probably 4 or 5 times a year. And if you guys want to learn how to like scale up from residential into apartments, go to commercialempire.com. commercialempire.com. Hit me up on that, and my team will reach out and get you details on what the next event looks like. And I partner up with mostly people that come to those events now because I know that they're educated the right way on how I do deals. And so we're in the same, mindset. We have congruent mindsets, and then, I sponsor them, and I feel comfortable with those people because I know them personally. So those are a lot of people that I partner up with on deals now.
Sounds like a plan. Sounds like a plan, guys. So definitely check out those CLEturnkey.com and commercialempire.com, and reach out to him on Facebook as well. So Tim, man, it was a real pleasure. You gave us a ton of information. You went deep onto a lot of subjects. So I really appreciate that. And, hopefully my audience was able to learn some things as well. And so, yay, man, I wish you continued success.
Dude, Juan, thanks for having me, man. I appreciate everything that you do and all the value that you give. So keep rocking and rolling, buddy.
Thanks a lot.